What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. I'm your host, Ryan Pulis, and today we're diving into a favorite topic of mine, maybe yours as well. That's the short-term rental loophole. So I know we've talked about this before, but thanks to the one big, beautiful bill passing, we've now got 100% bonus depreciation back on the table for 2025 and beyond. That's right, it's now permanent with no phase out. So if you're in the real estate game or thinking about getting in, you're going to want to stick around for this. But before we get into the tax strategy, a reminder, just the first priority with any short-term rental or any rental for that matter is finding a property that performs in cash flows. So the tax benefits are awesome, but they're just a bonus. Don't buy a bad deal thinking the IRS is going to save you, because they won't. I've seen too many times where someone goes into a deal hoping for the tax benefits or focused primarily on the tax benefits, and then the deal it's not a good one, and it really eats away at those tax benefits. If you're not generating positive cash flow, it's going to eat away any tax benefits very quickly. Always make sure the property is a performing asset first. All right, so let's dive into the tax piece. So the short-term rental loophole really is a loophole in the sense, meaning it was an unintended outcome from the tax code. It wasn't unintended at the time, but things have changed. When this loophole was put in place, it was from the 1986 tax law that created the passive activity loss rules. The key part of the code that applies to short-term rentals was really designed more for hotels. There weren't Airbnbs and VBRO back then. So normally, all of your rental activities are considered passive. That's under the IRS passive activity loss rules, section 469. All rental activities are default passive, even if you materially participate. So what's that mean? It means any losses that you rack up on your rentals cannot be used to offset your W-2 wages or your business income. Instead, they're carried forward year after year, waiting until there's passive income to offset those losses. Now, there are exceptions. So that's the kicker. One qualifies as a real estate professional. We've talked about that several times. But not everyone can have 750 hours a year involved in the real estate business. So not everyone's going to be able to qualify as a real estate professional. But there's other exceptions, one being the short-term rental loophole. So under the regulations, under section 469, the code section 469, the rated and the related regulations, if your average guest stay is 7 days or less, your short-term rental is not treated as a rental activity for purposes of the passive activity loss rules. So translation is you're really operating like a business. When it comes to businesses that you invest in, what you need to demonstrate to deduct losses is material participation. So with the short-term rental, average guest stay of 7 days or less, you're out of that default passive bucket. So now if you can prove material participation, your short-term rental losses can offset your W-2 income, your spouse's W-2 income, your business profits, all of it. Now, material participation, we've said that a few times. What exactly does that mean? It means you're involved in the activity on a regular, continuous, and substantial basis. There's 7 different tests that you can use to demonstrate material participation, but we're going to focus on the 3 main tests that are common for short-term rental owners. So first, we have the 500-hour test. If you participate 500 hours or more during the year, you're going to pass this test. Next would be the substantially all test. So if you're doing everything, cleaning, managing the books, handling repairs, taking care of all the bookings, you pass. No one else is involved. Third is we have 100 hours and more than anyone else test. So if you work at least 100 hours during the year and more than any other individual involved, you're good. So yes, you can have some help in this case, like a cleaner or a handyman, but you need to log more hours than them and hit that 100-hour minimum. And with all these tests, good documentation is key. Be sure you're tracking your time. Now, short-term rental depreciation is handled a bit differently. Even though most of the time your Airbnbs and VRBOs are properties that would be considered residential, from a tax perspective, your short-term rentals are non-residential property under the tax code. So they are depreciated differently. And the reason is because the units are used on a transient basis. So think, your Airbnb and VRBOs. These aren't long-term tenants. So instead of the usual 27.5 straight line depreciation for residential units, short-term rental properties are depreciated over 39 years. Common error. I see this is missed often. But so you have this longer depreciation period, but then that's where the cost segregation study comes in. Bonus depreciation to really save the day and help you save a ton of money of taxes. Your cost seg study is going to carve about 20 to 30% of the building's cost into 5 and 15-year properties. So not that 39 years that we were just talking about. And now with 100% depreciation back for 2025, you can write off those portions, the 5 and 15-year property, in year one. So quick example, you buy a $500,000 short-term rental. A cost seg study allocates $125,000 to 5 and 15-year property. With 100% bonus depreciation, you write off that $125,000 in year one, and it can offset your business income or your W-2 income. Huge deduction. Next, one thing that comes up a lot is people are curious where your short-term rental activity gets reported. Is it Schedule E or Schedule C? Schedule E is where your typical rentals go. Schedule C's are for your self-employment income. So I hear this debated often. The IRS says Schedule C, which is subject to self-employment tax, the Social Security and Medicare, it's on top of income tax. To report it here, you are providing substantial services like daily maid services, meals, transportation. So things like a hotel or a bed and breakfast. Schedule E, you're really just renting the place. You're not running it like a hotel. You're not providing food. And you're still allowed to offer cleanings in between tenant stays, though, not while they're there. So for most short-term rental hosts, it's Schedule E is where that activity belongs. Now, some common mistakes to avoid. Just 3 things I see quite often. 2 we just talked about. We have short-term rentals being reported on Schedule C when they don't belong there, depreciating the short-term rental over 27.5 years rather than 39. And another one is the short-term rental losses being claimed without the material participation. That's key. Without that material participation, you cannot deduct your losses. I see these 3 errors all the time on returns we review. So make sure you or your tax pro are handling these in the correct manner. You don't want to screw this up, especially if you're using a cost seg study bonus depreciation. That's a big number to get wrong. Now that's really the tax piece of it. We've covered the taxes. Let's just briefly talk about some tips for running a successful short-term rental. So we're going to shift gears a little bit. Tax strategy down. We've covered that, but now running it in a good way to really make sure you're maximizing your cash flow. So first, you want to optimize your listing. Use high-quality photos, a really nice description. Use dynamic pricing tools like Price Labs or something similar that will adjust your pricing based on various different variables and conditions at the time. You don't want to just select a price and set it and forget it. Make sure you enhance your guest experience. So make sure things should really be clean. Have amenities like Wi-Fi, toiletries, maybe a welcome basket, maybe something that's showing your tenants or guests what they can do in the area, your favorite spots, things that would help attract people to your rental. Make sure you streamline your operations so you can automate bookings and messaging. There's platforms like Guesty. Use smart locks for easy check-ins, getting in and out. For security, you probably want to have a doorbell or something with a camera in it so you can see the guests coming in. Make sure you maximize your bookings by listing on different platforms and encourage guests to leave reviews. Also, make sure you're complying with local regulations. So every area, cities and counties, they're going to have their own short-term rental laws. You might need a permit. There may be occupancy or sales tax to deal with if you're doing any direct bookings rather than going through like an Airbnb or VRBO. Often, and like an Airbnb will handle the tax collection and remission for you. But again, even that can vary depending on location. You may need specific insurance for short-term rentals. Another good thing that you can explore to attract guests is create a unique experience. Try to have a theme or some little like personal touches. Those can really go a long way. Remember, short-term rental is not just about the tax breaks. It's about creating a good guest experience that keeps your calendar full and really helps create a nice cash flowing asset for you. And then keep those tax benefits as a bonus. So to recap, the short-term rental loophole allows you to use your rental losses on the short-term rentals against active income as long as you materially participate. Pair that with a cost segregation study and bonus depreciation, and you can really have a nice tax saving strategy. So again, though, buy right first, get the right property in place, and then the taxes come second. And if you're wondering how this fits into your situation, hit us up. We are running a special on our short-term rental tax plans. So if you're interested, fill out our client intake form located in the show notes. That'll get the process started, and we can start a free discovery session and go from there. That about does it for today. Don't forget to subscribe and share this with your real estate investor friends. Also, leave us a 5-star review if you enjoy the show. Until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax-related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's THEPULICEGROUP.com/contact.